story in some ways. Let's get back to our analysts who have been kindly waiting by just to give us a bit more of a read. Julia, so a bit more detail there from Bernie Brooks. Probably nothing much out of what you would have already read in the ASX note. But what do you make of this result today and that share price reaction up 2%?
Look, I think there's a lot of positives coming through from Myer. We've seen an increase in the service levels. They've also increased in market share, and it's quite impressive what they are achieving in terms of general merchandise. We have a look at that Myer One program. It continues to receive support. I think 500,000 new people to that loyalty program in that last year. And if we have a look at the result coming in slightly ahead of market expectations, we saw the result coming in at $139 million. The consensus was at $138 million. And Myer's own guidance was for a decrease of 15% in net profit. We've seen a decrease of 13% there. The key to this result today was always going to be FY13 guidance. Now, we were expecting to hear guidance of about $125 million, which is about 6% below the market consensus. But of course, Myer has not come out with any guidance today. And I guess the market expectation is that we'll continue to see like-for-like sales coming in under pressure in the new year. But now it does look like things are improving. The first half, we did see sales decreasing by a much greater amount than we saw in the second half. So it does look like the environment may be stabilising. Of course, what we have seen are rate cuts in May and June, and they're yet to flow through to that consumer environment. If we see more rate cuts come out from the RBA later on in the year, that could be good news for the consumer discretionary areas. Myer's shares, of course, have been under pressure over the last year, down by 15%, but it does look like the market gaining a bit of comfort from these results, and a lot of positives coming through for Myer in the past year as well.
Peter, winning that war, as it were.
Well, Telstra's got 46% of the mobile market share here in Australia, and of course part of that has been the problems that Vodafone has been having, which has helped the momentum that it's seen in its mobile sales. But of course this is all about 4G, this iPhone 5, and if we have a look at the 4G network, all the carriers in Australia have it with just one exception, and that's Vodafone, which is planning to switch on its 4G network at the beginning of 2013. So this iPhone 5 release could be more bad news for Vodafone, which has already had a tough 18 months already. But if we have a look at the market for mobile phones, we are starting to see probably a peaking in penetration in terms of handheld devices. It sits at over 100% here in Australia, and it's becoming more about data. It's all becoming about data at the moment. We saw Optus as well as Vodafone cutting their data allowances by 25% earlier on in the year, and then Telstra followed with a 20% premium to data. And of course we know that the tablet demand, such as the iPad, has really been growing that demand for data. So for the carriers, it's a lot of it is around data. The other part of it, of course, is about consumer momentum, buying that new iPhone 5, and this is about pricing as well as data allowances. So we'll be watching the pricing packages coming out from the carriers. But the other side of the equation is that the mobile landscape has changed a lot in terms of revenue composition because of apps as well. Apps such as WhatsApp, which has taken away some of the SMS demand, and of course SMS used to be about 4% of Telstra's revenue. And then things like Skype, which really eat into things like international calls. So a pretty exciting day for those Apple fans. iPhone 5, it will really be about consumer demand as well as data. And I guess the big loser in this may be Vodafone, because it doesn't have its 4G network switched on as yet.
The other the hardware stores, when it comes to really, the main game is the supermarkets, the Coles v Woolies, isn't it? So how does it fit into in the broader context, and particularly if people are considering trading or investing in these companies?
Well, I think if we have a look at Woolworths and Wesfarmers, the reason why that hardware space is so attractive is because in the last few years it hasn't been unusual to see double-digit growth in this area. So not surprising that Woolworths is trying to get in on some of that very good growth momentum. We have seen some of that growth from Bunnings really pull back a little bit, but they're still planning on a pipeline of about 88 store rollouts, about 16 new store formats. So it really demonstrates the attractiveness of this do-it-yourself hardware area, and the type of growth that it's still attracting in this very difficult consumer environment. So not surprising to see Woolworths trying to roll out their master stores as quickly as possible, given the growth rates that we have seen from Bunnings in the past. So no doubt this is an area that is going to intensify in terms of competition. So not only are we seeing supermarket wars, but that hardware space as well. They're both fighting for market dominance there, and of course Bunnings is a dominant one there, seen some great growth rates in the past, and really Woolies wanting to try and get a slice of that action.